One of the most successful entrepreneurs in America over the past 50 years is going public with his fourth and final prediction about a scenario he calls America's Nightmare Winter. You've probably never heard of Bill Bonner, but in addition to owning an interest in businesses all over the globe, he also owns more than 100,000 acres with massive properties in South America, Central America, the US, plus 3 large properties in Europe. Bonner says, we're about to enter a very strange period in America, which could result in the most difficult times we've seen in many, many years. Bonner has made 3 similar predictions in his 50-plus year career, and each one proved to be exactly right, although he was mocked each and every time. That is why I strongly encourage you to read about Bonner's fourth and final prediction, totally free today. It's all spelled out in a free report we've put together about America's Nightmare Winter scenario. Get the facts for yourself. Go to AmericanWarning2022.com to get your free copy of this report. Even if he's only partially right, it will dramatically affect you and your money. So again, www.AmericanWarning2022.com. Welcome to Making Money. This is Matt McCall. Thanks for joining me. A very special guest on the show today, Brett Eversole. He is the editor of True Wealth, one of the great publications in our industry. It's been around for a while. I've known Brett for years, a colleague of mine that we actually agree on a lot of things right now. But we're going to talk about the markets, where Brett sees opportunity, and the one investment he's taking on the island for the next 10 years. Coming up right now on Making Money. And here he is, Brett Eversole, the editor of True Wealth. Thank you so much for joining me, Brett. I know we've known each other for a few years now, work a little closer together in the last year or two. And I'd say you and I might be a bit of an outlier for a lot of the people here at Stansberry because we've actually been somewhat bullish as of late and see some opportunity. A lot of our colleagues are still on the other side. And I think both of us agree, Brett, that we believe that because we believe inflation has likely peaked and will probably roll over going into next year. I'd love to get your updated view on where you think inflation is and where you think it's going to be going.
Yeah, well, thank you, Matt. I always enjoy talking to you, and thanks for having me on. First time on the podcast, so I appreciate that. And I always enjoy talking to you because you and I come at the markets in a very similar way. And I think that we come at it with optimism, and that there's always a reason to be optimistic in the market, in my view, because I think Warren Buffett said, like, if you're betting against the market, you're betting against, human ingenuity, something like that. And so I'm always come in with an optimistic view and look to kind of find the positive in whatever's going on. And I think that the big thing that's drawn or caused the drawdown in the market for the last year has been inflation. That's been the real problem. And because of that, the Fed's had to hike rates and everything has changed. The entire world, we went from this 0 interest rate policy where there is no alternative to, well, now there's all these alternatives. You can get short-term bonds at 4.5%. If people assume that that's going to last forever, but if you start looking at the inflation print, so for the last 4 months, the month-over-month change has averaged 0.2% a month. If that trend continues, we're going to be below 4% inflation, I believe, May of 2023. The Fed's definitely going to hike rates in December, probably 50 or 75 basis points. We'll be over a 4% Fed funds rate to start the year. If they keep hiking at all and inflation keeps dropping at that rate, which seems pretty darn likely at this point, we're going to have a Fed funds rate well over the inflation rate by maybe March, April, definitely by May of next year. And if that happens, we're almost certainly going to see the Fed cutting rates next year, as opposed to this hiking cycle that people just assume is going to continue to infinity. It's easy to look at the inflation rate right now at 7.7% and think, well, the Fed funds rate has to get up above that level. That's not what's going to happen. Inflation is going to drop very quickly. And all of a sudden, we're going to be in that spot where the Fed's going to be hiking rates. And that's just going to completely change the financial dynamic in, stock market, the bond market, the real estate market. It changes the game for everything.
I agree 100% with you. At our conference a few weeks ago in Boston, I had some chart I got from an analyst, and it showed basically what you just said, Brett. If it averages 0.2% or 0.1 or flat, and then it showed where CPI would be in the next 12 to 18 months. And there's scenarios in my mind where by middle to late next year, we could see inflation down to 2.5%, 2% to really the Fed target. And saying that now, people probably think we're crazy. because you are in a situation where, obviously we had inflation at 40-year highs, and it hurts because a lot of people, it's the first time they're really in adult life dealing with inflation like this. And I view it as, a lot of the stuff the Fed has done, and I'm not a huge fan of the Fed by any means, Brett, but, by raising rates and the moves that they've made as of late and being very aggressive with raising rates, I think you're right. It is going to make its way into the market, and you're going to see inflation roll over. The thing is, do you think the market how do you think the market reacts to that? Do you think people start buying now in anticipation of it that you and I have, or do you think we have to wait for the numbers really to roll over for that to happen?
Well, I mean, markets are generally forward looking. I mean, we all know that, right? And sentiment is just incredibly bad right now. I know I just read about the conference board does a survey of CEOs, and CEO sentiment towards the next 12 to 18 months of the business cycle is like the lowest it's been since mid 2009. Consumer sentiments through the floor, everything that you look at, stock market sentiment in almost any gauge is down. In many cases at either a multi-year low or maybe a multi-decade low. Now, that doesn't mean that the bottom is in, but that is how bottoms form in the market. And the news will continue to get bad when the bottom has already happened. So I don't want to say for sure that low we had in October is going to be the ultimate low. I mean, I think the question becomes, if we do get a recession, which seems pretty likely, how bad is that recession? How long does it last? And really, what does it do to S&P 500 earnings? Because that's really, I think we're going to have a switch that's going to happen where everybody focuses on inflation in 2022. Once people realize that's under control, the question is going to be, well, how bad are earnings going to get or not get? And if those are able to surprise at all, then I think we have the potential to, I know you've said that you expect a U bottom as opposed to a V. I think what we could see is kind of an elongated move for the next 6 or 8, 9 months. And then we might get a real blowout quarter to the upside where you could get a big spike higher in prices. Whether that happens in Q1 or Q2, it's hard to say, but I think that's a real possibility.
So in general, and I'm not to put words in your mouth, you would lean more to the side of allocating money probably between now and the end of the year to stocks when there's opportunity that you see in the market.
Yeah, definitely. And I know one of the things I was thinking about, I was talking with a friend earlier, and like I said, people assume we're in this new paradigm where the Fed's going to not be accommodative and they're going to keep rates high for a long period of time. If inflation solves itself, that paradigm is going to really go away before it had hardly started. It feels like it's been doing this for a long time, but it's been 10 months. It could be over in 5, 6 months. Mm-hmm. But if you look at the high growth stocks, the ones that are kind of long duration stocks, they're down 70, 80%. If we get Fed funds below 2% by the end of next year, like all of a sudden those businesses look like incredible bargains. And a lot of those businesses have the potential to produce real cash flows. It's not like 2001, 2002, where they were kind of made up companies.
Yeah, you make a good point because people try to equate this obviously to 2000, tech bubble, '08 financial crisis. And I hate to say this time is different because you never want to say that, but
every time's
still driven by psychology, right? It's always psychology. But what we had in 2000, like you just mentioned, we had companies that truly had zero business model, almost like some of these cryptocurrency projects have nothing going for them. I like cryptos to an extent, but a lot of projects have nothing behind them. That was the dot-com bubble. There's good stocks, and I may be debated on this, but to me, there's some good innovation technology stocks that are down 70 to 80% from the high. Granted, at the high were they overvalued? 100% they were. But that pendulum has swung too far, Brett, to the other side that there's opportunities, I believe. That being said, I don't know either if we've hit the low or not. We may have one leg lower. I don't know. I know that looking at a lot of stocks, and you and I have had this discussion before, buying now and having a 3, 5, 7-year time horizon, I feel comfortable because I don't know if it's going to go straight up or have another pullback, but I feel comfortable holding good companies. So that being said, I read a bunch of your stuff recently, and I'm not going to mention names of the stocks or anything you recommended, of course, but you recommended something in international markets, and I think you can mention the name of the country if you want, but I found it extremely interesting. Do you see opportunity right now outside the U.S.? And we just talked about the opportunities here, but do you see opportunity outside the U.S. as well?
Well, so like I was saying, like with the Fed and inflation and where rates are going and where they are and where they might be going, to me, that story is kind of like every financial story right now. And so you ask about international markets, and that really becomes a question about the dollar, right? So the dollar was up like 30% or 35% over the last 18 months, something to that effect. And that's absolutely crushed foreign markets. That's happened because the Fed has been the most aggressive central bank by a long shot at hiking rates over the past 9, 10 months. But recently, with that good inflation print, the dollar's come down quite a bit from 114, 115 down to 105, 106. International markets have a massive headwind when the dollar is soaring, going up and up and up. But they get that turns into a tailwind when the dollar starts going down. So I think we could end up in a spot where the Fed is actually cutting rates next year. That dollar decline kind of normalizes to something that we've seen over the last few years. And that's going to be a big tailwind for foreign markets. I mean, obviously, Europe has a lot of problems. We've covered China a lot in our service. China has its own problems right now. I'm honestly a little gun shy on China. We made what I thought were a lot of good recommendations earlier this year, and they've kind of been blown to smithereens. But I do think long term, the growth there, it's going to continue to be probably the largest growing economy in the world for the next 10 or 15 or 20 years. So I think there's a lot of opportunity there, but I mean, you got to be careful, and you got to have stops, and you got to do your due diligence.
Mm-hmm. Yeah, I agree with you with China. I look at some of these companies and the big cap names, names that you and I both know and like, and it's tough to not buy them here because they're literally cheap. I mean, they are like comparable to US, comparable to other peers. They're really inexpensive, and they're being priced as if China's going out of business. Not the company, but as if China's going out of business. But I agree with you. I think when you buy something like that, you have to have some type of plan. You can't just buy them because the volatility is so high. And
I think the problem with those big tech China names right now is that they're very much divorced from fundamentals. I mean, because of what's happened over the last 18 months or so, most foreign institutional money has moved out of those stocks, and it's going to take a lot from the Chinese government to get that money to come back in. So they're very much divorced from fundamentals. Like you look at a company like Alibaba, maybe it trades for like 10 or 11 or 12 times earnings. But another problem there is that their top line revenue growth is slow to a crawl. I think the most recent quarter, Alibaba's top line was only up 3%, whereas like 3 years ago, it was up 30%. So there's definitely problems. But the question you ask yourself is, does Alibaba have the potential to grow 10, 12, 15% top line over the long term? I think the answer to that's probably yes. Mm-hmm. But if you're going to wade into those companies, you got to be just aware of the risk you're taking.
Yeah. There's opportunities over there, but I agree. And, not to get too much in China, but the one area that I've been looking at recently is the consumer in China. And a lot of the stocks, they don't trade here in major exchanges. You have some ADRs that trade in pink sheets, but especially like the millennials are really starting to spend quite a bit of money. And they're all about, sporting equipment and all that kind of stuff. There's a lot of great opportunities over there. Based on what your prognosis is for the market and for the dollar and for the Fed inflation, do you see any big moves, any opportunities or asset classes that we should be staying away from?
I mean, I think one of the big opportunities that people kind of assume is dead in the water and it's just going to get worse and worse and worse from here is real estate. And I think, again, this all comes back to that same idea of much, much higher rates. You look at the single family home market, mortgage rates went from below 3% to over 7%. And they just had a massive drop in mortgage rates this week. That really changed the game as far as affordability and who can afford homes. But what's interesting about this time versus in 2007, 2008 is back then, everybody lost their jobs. Everybody was underwater on their mortgage. Most people bought their homes 2 years ago or more, and they're up 40, 50%. Who have so much equity in their homes. So you don't panic sell your house if it's not a losing asset for you and you haven't lost your job. So that's what happened in 2008. And we had this flood into the market. But if you think about long term, we're many, many million housing units short in the US. So there's this massive supply demand imbalance that's not going to go away. And you don't have a situation where people are going to be forced to sell their homes into a tougher market. So I think you look 12 months down the road, if mortgage rates come down from 6.5 to 4.5, I don't think they're going to be below 3. But if the Fed starts cutting rates, that's going to totally change that game. And I don't think we're going to see 20% year-over-year gains like we saw for the last couple of years. But it's very easy to look at the single-family home market or real estate in general and say, well, this is just a dead asset class. I think that's the wrong bet right now. I think there's a lot of opportunity right there.
Let me ask you something. You might know the answer to this. I remember I read it, but I don't remember the exact number. There was a lot of adjustable rate mortgages back in that crash. So that was a big issue when they came up. Obviously, rates have gone up quite a bit. I don't believe we're setting up for a large portion of those mortgages to be reset. Not as many arms, as they will, adjustable rate mortgages out there, because people are locking in at such low rates for 30 years, which is a smart move. So if we eliminate that as well, people will not be forced to potentially sell a home as well.
Yeah, I think the ARM number was around 20 to 25% of the market in 2006, 2007, and it's definitely below 5% today. And so
Yeah.
I think we will end up in this situation where people will feel kind of stuck. If you've got a 3% mortgage, maybe you want to move, but you don't have to. You might choose not to. And we've seen that, like existing home sales are down 30, 35%. So
Mhm.
like the market has moved to this gridlock state. But gridlock, people make the assumption that that's going to mean you have to dramatically cut prices in order to move sales. I think what it's going to mean is people are just going to change their lives. They're going to make different choices, and they're not going to be forced to sell because they have so much home equity.
Yeah.
You might have that like golden handcuff, if you will, of a 3% mortgage, and you'll choose not to sell. But also, it's about expectations and normalizing, right? So 7% mortgages seem really bad when you're used to 3, but in 2 years from now, when 4.5 will look really good compared to 7. And that's kind of how the real estate market always works.
Yeah, it's a great point, because we have a very short-term memory for certain things as human beings, and suddenly they're going to be excited for 4.5. You're going to see advertisements from mortgage brokers everywhere. Come get a great mortgage. It's down to 4.5%, when really it's
Refi.
double what it was, 2 years prior. But it looks good coming down from 7. I was
Yeah,
just looking at a
exactly.
chart of the ITB, which is an iShares home construction ETF, and it bottomed in June, and it did not retest it when it pulled back in October. It actually was a much higher low. And just about a week and a half ago, it was at a multi-month high, which that kind of tells me something. Those are housing stocks, housing related stocks that are holding up very well in the face of mortgage rates going through the roof, in the face of all those negative numbers we just talked about. That tells me something. How do you read into that?
Well, I mean, I think part of it is that they got really beat up in the first half of the year. I mean, to be fair, that June low, I think the ITB was probably off 40, 45%, something like
Mhm.
that. So dramatically more than the overall market. And I mean, these are going to be stocks relatively leveraged to the economy. So it's not surprising that they would go down a lot more than the overall market in that kind of scenario. But I mean, I'm not a technician by a long shot, but I do believe in, trends. And so to see that ETF not making new lows while the overall market is and performing pretty darn well, I mean, I think that's a really bullish sign. And I mean, I think if you think about the long term setup for housing, again, like many million housing units short, and those are going to get filled in with a lot of apartments and other kind of things as well. But we underbuilt houses for a decade coming out of
Mhm.
2008, like dramatically, like many millions of homes less than we needed. And you have to assume that's going to play catch up. Like at some point, we're not going to have enough houses, like really not have enough houses for people. And I mean, I don't think that there's any dry up in those folks' business anytime in the next 5, 10, 15 years.
Yeah, and I always believe in the demographic trends too.
Mm,
Millennials, which you are a lot of them are marrying at later in life, and family
yeah.
formations happening later in life. And a lot of millennials are now at that level where they're making good money. They've moved up in the world of employment. They're starting to get married, have children, and that's moving out. Okay, we're going to buy our first home. So you're seeing a big demand for homes, first time home buyers that do have money, and they have money built up. So, and I don't see that trend ending anytime soon. I think that
No.
trend's only going to accelerate for the next 10 years.
Yeah. Yeah. And I would imagine when the next generation comes through, it's going to be the same thing. You'll probably have even later household formation. I mean, we're just living longer, and people realize that their 20s are their pretty good years, right? There's no need to settle down when you're 19. You can do it when
Exactly.
you're
Exactly.
32.
Two questions before I let you go. One
Sure.
is, what type of advice do you have for investors out there right now? Because most people watch this show are individual investors, DIY to do it themselves, and a lot of them are honestly freaked out.
Yeah.
Because no matter where you were, you probably lost money in your portfolio this year. I mean, it's one of those years where it's just been a broad based beatdown.
Yeah.
Like we talk about in the show all the time, a 60-40 portfolio would be one of the worst years in history, which was always a safe place to be. So what is something that you tell your subscribers, to help them get through this type of situation?
Well, I think the most important thing, and hopefully you did this before the year started, but if not, you can start right now, and that's to have a plan. So it's very easy when times are good and things are going up to not think about when you're going to sell or what would make you change your mind on an investment or anything like that, because the price is just going up and up and up and you feel like a genius because you're making tons of money. But what you need to have whenever you make any buy there's no what you're going to do to sell. So we always use trailing stops in our products. If not trailing stops, we use some other kind of momentum based stop. But basically, if a stock you buy at 100 and then it goes to 200, if you have a 25% trailing stop, you're going to sell it when it falls 25% below the highest price. So if it then fell to 150, then you would go ahead and sell. And so I think that's the thing. Like, you need to have a plan, because when times get really hard, you'll want to freeze up and not know what to do. And so if you have that plan going in, you know what you're going to do, why you're buying this, when you're going to sell it, then you can just stick to that plan. You don't have to let your emotions get involved. And really, people make the biggest mistakes when they let kind of their emotions take over, because they're either feeling greedy or feeling scared, or one of those two things. And if you have that regimented plan set up ahead of time, and again, if you don't have one set up ahead of time, you can set one right now and then make choices going forward. And that's the best thing to do. So really, it's have a plan and then stick with it. Be very disciplined towards sticking with it. That's the key.
Yeah, it's never too late. And again, I think anything in life, we should have plans, right? I mean, it's fun to be, kind of off the cuff and do things. Nothing wrong with that. I get it. But especially when it comes to hard-earned money, we should definitely have a plan. So just to piggyback off that question real quick, if people were using stops, let's say, throughout the year and probably got stopped out of a lot of stocks and sitting with a large amount of cash right now, do you think it's time to start kind of picking and choosing, whether it be ETFs or stocks, in areas that you see opportunity, and just start kind of building that plan from here?
Yeah, I do think so. I mean, I think that there's probably not a huge rush. It's generally not a great idea to throw everything in all at once. But, with the overall market down 25% from the high, the NASDAQ down 30, 35%, some of those high growth tech stocks, like you say, down 60, 70, 80%. Like, there are opportunities out there. And it doesn't really matter if you get the actual bottom or not. If you're buying 25% off the high, you're doing pretty darn well 3 years from now. It doesn't really matter. So you don't need to get hung up on that idea that you've got to put it all to work all at the same time, all at the perfect moment. Like, that's never going to happen. It's not an achievable goal. So if you tell yourself you're going to do this, then you're setting yourself up for failure. So I do think there's not really a rush, but, start inching in now, and probably going to get a lot of good buying opportunities over the next 6 to 9 months. And you really want to have all that capital deployed by then.
Yeah, I agree. I think patience is very important here. I really think it's, there's no rush at this point, because volatility is going to be here for the foreseeable future in my mind, especially through the December meeting with the Fed. We'll probably see quite a bit. We have the CPI print, I think, the day before the Fed meeting. So that week's going to be a bit nuts heading into Christmas time. I'm ready, preparing for that week. Brett, ask everybody in the show. You don't have to answer, but ask everybody in the show at the end of the interview. I call it the island question. So
Sure.
If I were to send you and your family and whoever else you want to take with you to a beautiful island for 10 years, put your phones away, just enjoy life. But you had to buy one investment. It could be an asset class, it could be a stock, ETF, you name it.
Oh, man.
It could be cash. What's the one investment that you just got to have in your portfolio for the next 10 years?
Man, that's a good question. I mean, the boring side of me just says, buy the S&P 500 with some leverage, because I feel like that's always the good long-term bet. Maybe that's the way to do. Whatever the 2x S&P is the easiest way to do. I mean, it's a boring answer, but again, it's that idea of, like, over the long term, the stock market goes up, and there's going to be a lot of pain in between. But if you can just hold steady and have that optimistic view, you're going to do really darn well. So I guess for 10 years without having to think about anything, that's the lowest risk, highest upside thing to do.
I think that's a great move, because if you think about it, you take any rolling 10-year period in the S&P going back in history, I think you're up 90% of the time over any rolling 10-year period. So that's pretty good, pretty damn good odds. I'll take that all day. Somebody said I have over 90% chance of making money. Hell, I'll put a lot of money in there. And what's crazy is that's the S&P 500. It's not like you have to do something crazy. It's literally investing in the 500 largest publicly traded companies in this great country. It's amazing. Yeah. So
it's a good
hey, listen, Brett, thank you so much for joining me. We want to get you back on soon, especially when we're really right and the market starts taking off. We could take a little victory lap together and
sounds great.
And come on and talk about that. But again, thank you so much for coming on and your optimism and for everything you do for our subscribers. But we'll see you soon.
Thanks, Matt. I appreciate it.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.